savvy wealth builders are using this hidden gem to help boost their wealth building journey. It is a taxable brokerage account. And even though it has the word taxable in it, there are tax benefits, estate planning, and flexible lifestyle benefits to go along with it. We'll break down each one of these areas to help you boost your financial future. Let's chop. When you're investing for your lifestyle now and your retirement future, it's key to have tax location diversification, different types of accounts like tax deferred, tax free, and taxable in order to help you live your life your way. All right. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way. And if you like what you see, hear, and feel on the show, hit the subscribe button and share with your family, friends, and colleagues. All right, let's chop. The word taxable scares a lot of people because people just don't like tax. They want to keep more of what they earn in their pockets and not give a whole bunch of money, unnecessary money, to the government. But when you have a taxable brokerage account that aligns with your other retirement accounts, like your tax deferred and tax-free accounts like Roths, then you have tax location and investment account diversification, and you are using your tax location to help you with your flexibility and withdrawal freedom, your tax benefits, your retirement planning, and how you live your lifestyle. So let's get into it. What is a taxable brokerage account? Well, it sounds like it sounds. You are placing after-tax money into an investing account, and then when you withdraw the money, it's susceptible to long-term capital gains rates rather than ordinary tax if you hold the investments longer than 1 year. This is a great benefit, and we'll talk about that in segment 2 when we talk about taxes. So this is the main difference between a taxable brokerage account and tax-deferred accounts. When you contribute money into a tax-deferred account, you are contributing money pre-tax, meaning you have not paid tax on those contributions yet. When you contribute to a taxable account, you have already paid tax up front and you are placing that money into an account. And then over time, it'll grow earnings, and then you pay long-term capital gains on those earnings after holding it 1 year. Okay. That's the biggest difference. Now, there's also differences like you don't have to pay penalties on your withdrawal. So a lot of flexibility comes along with your taxable brokerage accounts, which is another significant difference from your tax deferred accounts. Okay? You're able to withdraw money without penalty or ordinary gains tax if you hold those investments longer than a year, but mainly without penalty, because if you have an account like an IRA or a 401k at your employer, then if you withdraw monies before 59 and a half, then you have a penalty. With taxable brokerage accounts, you don't have that penalty. And why do you need flexibility in your life, right? Well, you have goals and preferences in your lifestyle that you're trying to fund that you need access to your money now, right? For example, you may have a second home that you want to invest in. You may have college funding to align with your 529 accounts as well. You have travel that you want to fund. So there are a lot of areas in life that you can use a brokerage account in order to help you fund your lifestyle now. An example of this account is perhaps you've been saving for a while across all 3 accounts, right? Tax-free, tax-deferred, and taxable, which is your brokerage account. And you have $100,000 to $200,000 in these accounts. Well, instead of having to pay a penalty for early withdrawal, which is 10%, or be susceptible to ordinary income tax, if you hold your investments longer than a year, then you get to pay long-term capital gains tax, which is typically 20% plus 3.8% for high income earners, which is significantly less than the highest marginal tax bracket of 37%. So flexibility and smoothing out your lifetime tax rate over time is key to brokerage accounts. All right, that's a great pivot to talking about taxes when it comes to brokerage accounts. Now, we've already said that the long term capital gains rates is different between, now, you may have heard me talk about in last segment that long term capital gains rates around 23% for high income earners is significantly less than an ordinary marginal tax rate of 37%, right? Now, you're not paying 37% on all your money that you withdraw because the tax system is progressive and it's a tiered process. That said, if you're in a 37% tax bracket, you are having a significantly larger amount of tax on your income and your withdrawals out of your taxable brokerage accounts, ordinary income tax, than you would if you held those investments for 1 year or longer. Also, regarding tax, you want to be mindful of what type of investments that you're placing in a brokerage account. Now, if you have high dividend paying stocks, you do not want those in your brokerage accounts because those individual stocks and ETFs and index funds that are kicking out dividends or have high turnover rates, then you have to recognize that income coming into your account as ordinary income and pay ordinary income tax, which is totally against what you're trying to do with the taxable brokerage and holding those investments, right, longer than 1 year to get that lower long-term capital gains rate. So the type of investment that you're placing in your brokerage accounts are very important in order to increase tax efficiency. So typical index and ETF funds and individual stocks that go into a brokerage account, again, are those that are not kicking off dividends or having high turnover rates. Here's a couple of investments to consider placing into a taxable brokerage account. One investment that you may consider are growth stocks. Growth stocks are individual companies that are trying to grow their firms exponentially and reinvest their monies into the company rather than paying out dividends to investors. So remember, right, dividend income is taxable, although dividend income has a favorable tax rate than ordinary income. You're still having to pay tax in the year that income is recognized. And those growth companies are not trying to kick out a whole bunch of dividends because they're using those funds in order to reinvest to make company grow bigger, right? So that's a consideration. And lastly, in a brokerage account, you get to do something called tax loss harvesting. Tax loss harvesting is selling positions in your account that have experienced loss. And you can harness those losses and gather those losses to offset gains when you're taking advantage of tax gain harvesting. So those positions that have gained over time, then you may want to trim some of those down when you are doing your rebalancing in your portfolio to get your allocations in line. You're pocketing some gains, paying long-term income tax on those gains, but also over time, you are offsetting some of those gains with your losses. So tax gain harvesting to rebalance your portfolio and trim some of the gains in your portfolio that you've experienced over time. And then tax loss harvesting, selling those positions that have experienced loss. You can use tax losses to offset tax gains dollar for dollar. And then you can use an additional $3,000 of tax loss to offset some of your taxable income. If you go over the $3,000, then you get to save those tax losses to offset gains in future years. What a benefit. And studies show that folks that participate in tax loss harvesting every year tend to increase their after tax returns by half, 1 or 1.5% annually. So tax loss harvesting and tax gain harvesting is a pretty good strategy. All right, we're coming around the bend. Here is another area where taxable brokerage accounts have a really good benefit. It is your estate planning. So when you have a mindset to pass along some of your assets to your heirs, then these type of accounts can help you immensely by receiving a step up in market value at the time of your death and then passing those assets on to your heirs tax-free if they sell immediately. Well, how does that work? All right, say that you have $100,000 in cost basis in your equity positions. This could be your individual stock plans or your ETFs or index funds. And then you have subsequently had gains in those funds of 200,000. So you're at 300,000 account balance. Well, if you were to pass those assets on to your heirs and receive no step up, then there is tax on those gains of $200,000, right? Well, the step up benefit says in that same scenario, if you have 100,000 in cost basis, 200,000 in gains, well, the cost basis steps up to the full market value of $300,000. So if the heir receives that when you pass away, they can immediately sell that $300,000 and not pay any tax because they have received a step up in value. Step up market value is an incredible tool to pass on assets to your heirs in a tax efficient way. Now, here's a little nugget that a lot of folks don't talk about, but I'll share with you really quickly that step up is called step up in quotes because it's actually step two. And those investments could lose value over time because so it's going to step to the fair market value. But generally, over time, it is step up because over a 10, 20, 30-year period, history tells us that the stock market tends to go up over those long-term periods. So we're assuming that your assets are stepped up in fair market value, not stepped down. All right, that's what we got for you. Now, even though the taxable brokerage accounts has the word taxable in it and it scares a lot of people, there's a lot of benefits to your brokerage account. So just call it brokerage, even though it has a taxable element to it. You have tax efficiency, or as long-term capital gains, estate planning, stepping up to market value, and a lot of flexibility, avoiding penalty for withdrawal and paying for those areas that you value most. For example, second homes, home upgrades, education funding, and lifestyle spending. All right. As usual, if you like what you see and heard and feel on the show, please like and subscribe to the show and share with your family, friends, and colleagues. And until next time, we'll chop soon. Cheers.